Hi, my name is Chudyk. I'm a partner at Traphagen Financial Group, and I will be giving a presentation on how to save tax and build wealth under the new tax laws. This presentation will inform business owners of what they need to know with the new tax law. We will cover C corporations taxed at a flat 21%, pass-through entities, and the new 20% deduction. We will define what qualified business income is, who qualifies and who does not, why our firm feels it is imperative to get a structure analysis done. We will give you examples of changing business structure to maximize tax savings, as well as the business and tax planning we have done within a current or proposed structure. Also to be discussed will be depreciation and the changes to Section 179 and bonus depreciation, as well as meals and entertainment. C corporations. The new tax law was aimed at C corporations, especially those located outside the United States, to bring their business back home. So what would be the advantages of being a C corporation? First, a flat tax rate of 21%. Previously, the top rate was 35%. No loss of state tax deductions at the corporate level. With pass-through entities, they are now limited to 10,000 state tax deductions on their personal taxes. And compliance is easier, in which shareholders and/or partners may not be required to file in all states. This sounds great, correct, but let's look at some of the disadvantages. First, there's no preferential tax treatment of capital gains unless there's a sale of stock, and majority of companies are being sold as asset sales. Sale of business may result in double taxation. Distributions taxed as dividend income, and this is one of the biggest disadvantages. After the C corporation pays their federal and state tax at the corporate level, the taxed earnings that remain in the company can be used to reduce financing, grow the company with acquisitions, investing in employees, paying off debt. However, if the owners take a dividend out, the owner will pay a dividend tax of 20%. Therefore, a business owner who takes all of the earnings out of the company would pay corporate tax at 21%, plus an additional 20% for dividend tax, and therefore, in these scenarios, a C corporation is not the right choice. And then the final disadvantage is accumulated earnings tax, which we will discuss further in the next slide. What is the accumulated earnings tax? This is a tax that is assessed by the IRS when earnings are accumulated in excess of reasonable business needs. This is a big disadvantage of trying to build up cash flow and take advantage of the flat 21% tax without getting double taxed. However, there are ways of getting around this. Some examples of reasonable business needs would be business expansion or acquisition, paying off debt, provide working capital, and contingencies. What the IRS will want to see is that the earnings that are left in the company are not being there just to reduce tax, but they have a business need, such as the ones we just went over. Now, what is this 20% deduction I am sure everyone is hearing about? Technically called Section 199A, when Congress was passing the C Corp 21% flat tax, the small businesses, pass-through entities such as partnerships, S corporations, sole proprietors, were saying, what about me? Section 199A was created, which gives qualifying pass-through entities a 20% deduction on their qualified business income. But what is qualified business income? Qualified business income is an entity taxable net income which does not include the capital gains and losses, dividends, or interest. What is very important is that the W-2 wages to shareholders, as well as guaranteed payments to partners, do not qualify for a 20% deduction. They are taxed to the individual without this 20% deduction. I wish the calculation for Section 199A was as simple as multiplying 20% to taxable income, but it is not. There are limitations. The first limitation is the deduction is the lesser of the 20% of the QBI, qualified business income, as discussed on the previous slide, or the greater of 50% of the business W-2 wages, which includes both employees and employers, owners, or 25% of the business W-2 wages, including both employees and owners, plus 2.5% of the unadjusted basis of qualifying fixed assets. Let's give an example that could hopefully highlight this. If my qualified business income was $300,000, the 20% deduction calculates to $60,000 of tax-free money. However, in this example, the company has W-2 wages in total of $100,000. 50% of that amount calculates to $50,000. Therefore, the QBI deduction would be limited to the $50,000 and would not be able to take full advantage of the $60,000. If, on the other hand, the W-2 wages were in total $200,000, 50% limitation would calculate to $100, and therefore I get the full 20% deduction of $60,000. The second limitation that we highlighted was the 25% of payroll and 2.5% of unadjusted property. And this was put in for the rental companies that do not typically carry much payroll, but would maximize the 20% deduction with the 2.5% of unadjusted cost basis, which means the cost basis on these properties not reduced for accumulated depreciation unless fully depreciated, meaning the cost basis is not reduced for accumulated depreciation unless it is fully depreciated. The second limitation is calculated at the personal level, shareholder or partner, in which the QBI deduction is limited to the lesser of 20% of QBI versus 20% of taxable income as reflected on the shareholder or partner's tax return. In case shareholders and partners have multiple pass-through entities, aggregation rules can be applied. So, who qualifies for the 20% deduction? Non-service businesses, including sole proprietors, independent contractors, partnerships, LLCs, S corporations, estates and trusts owning an interest in pass-through entities, rental real estate. Certain service businesses qualify, such as architects and engineers, and this applies whether it is passive or non-passive, but that is determined at the entity level. Now, who does not qualify? Specified service businesses that are defined by the IRS, such as CPAs, lawyers, doctors, investment advisors, do not qualify for the 20% deduction. Further, employees receiving W-2 wages do not qualify for the 20% deduction. There is an exception for specified service businesses in which if the qualified business income is under $315,000 for married filing joint or $157,500 for single filers, then even if you are a service business such as a CPA, lawyer, or doctor, you would still be able to take advantage of the 20% deduction. Further, the 50% of payroll limitation does not apply until income is over $315,000. The phase out is actually between $315,000 to $415,000 for married filing joint and $157,500 to $207,500 for single filers. Our firm has prepared countless structure analysis for our business clients, and that goes for our largest clients to our smallest clients. So why did our firm feel this was imperative for our business clients? We wanted to identify the most tax advantageous business structure, as well as prepare business and tax planning strategies in the selected businesses, as well as prepare business and tax planning strategies in these businesses. So what were the results? The results were permanent tax savings. We were able to maximize the 20% deduction. Our clients saw improved cash flows and were able to build wealth. What I'd like to do now is give 4 examples of actual situations we were faced with this past year for our clients and what we did in each of these scenarios to have our clients maximize tax savings, increase their cash flows, and build wealth. Obviously, the names of our clients and actual amounts won't be disclosed, but hopefully one of these examples can get you thinking of how this could help your businesses. The first example, the facts are, the current structure is a partnership. It's a non-service company with net income of $1 million. There are no employees on payroll, and the owner receives a guaranteed payment of $300,000. The challenge would be, due to the 50% salary limitation, this client would not be able to take advantage of any of the 20% deduction. As we discussed in previous slides, the limitation is 50% of all W-2s. Without any W-2 income for employees and/or owners, they would be limited to 0 deduction. Based on this current structure, the full $1 million would be taxed at 37%, assuming they are in the highest tax bracket. This next slide is an example of our structure analysis we prepare. This is a simple worksheet compared to the most we prepared because it's only 3 columns. And in these 3 columns, we're looking at whether this client, with the facts we just discussed in the prior slide, should be a C corporation, a partnership, or an S corporation. Now, sometimes this worksheet has 8 to 10 different scenarios as we throw in different variables, whether we adjust salaries, look at possible growth in income, adding on payroll, multi-state, New York City tax. But for this presentation, we'll keep it at the basics. As reflected in the previous slide, the net profit of this company is $1 million before any type of reasonable salary or guaranteed payments. If we look at the column labeled C Corporation, we will take $1 million of profit, reduce it by salary on the C Corporation of $300,000 for the owner. As discussed previously, the state tax would be deducted in full at the corporate level, which calculates to $63,000 in our example. Therefore, this entity's taxable income amounts to $637,000. The flat tax at 21% would calculate to $133,770 of federal tax. The residue would be $503,000 of income that would be left in the company. The next number you see in that column is $1,000, and that is the tax at the highest tax bracket, 37%, on the $300,000 W-2 to the owner, as well as the state tax at 9%, and then the Medicare and Social Security tax. At the highest rates, we're calculating the tax the shareholder will have to pay on that $300,000 W-2 is $150,329. The next amount of $100,646 is the dividend tax at 20% if and only if we take out the full $503,000 company as reflected above. If that money is taken out as a dividend in a C corporation, 20% would be taxed as dividend tax, 3.8% would be taxed for net investment tax, and state tax at 9%. 3.8%, 8% of net investment surtax, and 9% for state tax. When we take a step back in that scenario, if the owner took out all of the money that remained in the company of $503,000 on $1 million of profit, the combined tax would be $512,000, representing a 51.2% tax rate. And at that case, we would not recommend a C corporation for this client. If this client, however, said they would not take any of that $503,000 out and would the total tax for that year would be $347,000, and the rate would amount to 34.7% in total. And then we would possibly recommend a C corporation depending on when the client feels they would ever sell the company. Are they going to take out the retained earnings? Are they going to take out the retained earnings eventually? And when they do sell, are they looking at an asset sale versus stock sale? Let's say for this example, the client was going to take out all of the retained earnings. And most small businesses that we represent would do the same, in which if the client is going to want it. Therefore, the C corporation in this example would not be our recommendation. The second column shows the partnership, which is the current status of this client. $1 million of net profit. Now, as a partnership, you're not allowed to be on salary for the owner. It's called guaranteed payments, which is $300,000. The qualified business income is $700,000. However, the client will not get a $140,000 tax-free allocation because there's no W-2 salary. And therefore, the full $700,000 is taxed at 37% in this example and 9% for state tax. As a partner, the guaranteed payment as well as the $700,000 are subject to Medicare tax, security tax. Therefore, the taxes on the guaranteed payments are amounting to $160,000. When we calculate the total tax on this partnership, it amounted to $489,000. Our third example was, what if we change this partnership to an S corporation? Same facts, $1 million of net profit. The owner's reasonable salary now is $300,000. But as an S corporation, the owner is on a W-2. It's not a guaranteed payment. In both scenarios, the qualified business income is $700,000. The difference here is, with the owner being on W-2 income, the $300,000 is able to be allocated to that 50% limitation of W-2 wages. 50% of $300,000 calculates to $150,000. Now, this client could take the $140,000 deduction. By taking the $140,000 tax deduction, $560,000 is taxed, amounting to $270,000 of total tax. And then in addition, the $300,000 that came out in W-2 would be taxed similar to the C corporation at $150,000. However, the S corporation total tax calculated to $420,000. So when we discussed this example with our client, our recommendation was to change the structure of this company from an LLC to an S corporation. And by doing that structure change, our client saved $68,700 a year in taxes. And that's not a deferral. That is a permanent tax savings. This new tax law is supposed to continue to 2025. If our client stays at the same income level, that would be a savings of $68,000 a year for 8 years. In 8 years from now, by doing that change, our client would have almost $500,000 more in their pocket than if they stayed as an LLC. In our second example, the facts are the current structure is an S corporation. Taxable income before officer salary is $3 million. The one shareholder's salary is $1 million, and there is no wage limitation due to employee salaries, meaning the company has enough W-2 wages from their employees to cover the 50% limitation. The challenge is to maximize the 20% deduction. What did we recommend to the client? We kept the structure as an S corporation. However, we advised our client to lower their shareholder's salary to a reasonable amount of $300,000. By doing this, we maximize the 20% deduction. The $1 million of W-2 salary would not be allowed for the 20% deduction. Only the $2 million that passed through to the K-1. By our recommendation, now $300,000 is not allowed for the 20% deduction, but now $2.7 million will be allowed for the 20% deduction. By doing that change in payroll, $700,000 at 20% would be an additional $140,000 of tax-free income that our client was able to get each year. The tax savings on that is roughly calculated to $41,000. $41,000 for 8 years of this law without any time value money would have approximately $320,000 more in our client's pocket, and all we needed to do was planning within the structure they are in. Our third example, the current structure is an LLC. The partners receive guaranteed payments of $400,000. Taxable income is $600,000. $1 million reduced by the $400,000 in guaranteed payments. Our challenge is that guaranteed payments, just like W-2 salary to owners, do not get the 20% deduction. Therefore, in our example, only the $600,000 would be qualified business income and not the full $1 million. Our solution was to keep the structure as an LLC, but we reclassified the guaranteed payments as distributions. As long as the partnership agreement did not specifically state that the partner was to receive guaranteed payments, or if there was one, we would recommend to amend that partnership agreement. Therefore, we can treat the guaranteed payments as distributions and specifically allocate the income on box 1 of the K-1. What does that mean to you? By doing that strategy, we were able to maximize the 20% deduction. That was an additional $400,000 at 20%, which was an additional $80,000 of tax-free income by taking a look at the facts and recommending a strategy to our client and taking advantage of the new tax law. The last example we will go over was a client of ours as a partnership. And the partners were receiving guaranteed payments, but not taking any distributions. The client needed capital to accelerate growth of the business and wanted to expand. Based on our analysis, we changed the structure to a C corporation. The officers take a reasonable salary that they could live on. The profits were taxed at the flat 21%, and the retained earnings were not distributed, but rather invested to fund future growth, whether that was to reduce the financing they needed at banks, to purchase equipment, for acquisitions, for talented personnel. And the client, through discussions with us, had no intentions of selling the business anytime in the next 10 to 20 years. When we analyze this, the C corporation flat tax at 21%, being able to deduct the state taxes at the corporate level, and the client not taking dividends out and avoiding double taxation, this was the solution and strategy that can assist them going forward to build up cash flow and grow. Depreciation was another item on the new tax law bill. Section 179. This is the election to expense costs for property placed in service. The deduction limit increased from $500,000 to $1 million. and the phase out threshold increased from 1 million to 2.5 million. The Section 179 only applies to new assets. Bonus depreciation. This can amount to a 100% deduction for certain fixed assets that are placed in service, and this is effective until December 31st, 2022. This deduction increased from 50% to 100%, and it applies to both new and used assets. As a planning advice, if you have a client or if you are a business that invests extremely heavily into fixed assets and equipment, bonus depreciation is very useful for when a client's fixed assets are in excess of 2.5 million and they are phased out for Section 179, you can still take bonus depreciation. Also, certain state credits do not allow for an investment credit for any assets that take Section 179. Therefore, a business can take bonus depreciation and get the same deduction but still avail themselves to these credits. Meals and entertainment also changed with the new law. Items that are still 100% deductible are office parties, allowance included in employee wages. 50% deductible are meals with clients, vendors, new business, meals for board of directors or shareholder meetings, and in-office meals, which were previously 100% deductible. The big item is that entertainment, which was previously 50% deductible, is now 0%. So taking clients out to a football game, a concert, which used to be a 50% deduction and is now 0%. Also, 0% deductible is no business purpose, lavish, and extravagant meals. If you have any questions or would like a structure analysis performed for you, or to discuss further on ways to help your business save tax, increase wealth, you can contact me at chris@tfgllc.com. Also, attached to this presentation is just a few pros and cons for each entity structure, C Corp, S Corp, and partnership, that you may be interested in to see what are the pros and cons for each structure. Thank you so much. Have a great day.